suggest to your clients that they should have some exposure to gold and silver within their asset classes?
Yeah. I generally recommend a non-zero position, right? And obviously the sizing can vary based on someone's, what type of capital they're running, what their conviction is in the asset. But I generally think that, zero is not the right number for most people, and that having, some position is worthwhile. And then of course, how they want to hold that can differ. I mean, one of the advantages of gold and silver is that you can custody some. It's nice to have a bearer asset. And of course, there's also ways that you can link it to, like payment mechanisms and things like that. So for people that want that price exposure and are willing to have someone else custody it. And so I think that, especially given what's happening in sovereign bond markets, and then the longer term question about, what are countries going to, use as sovereign reserves if we go through this kind of long term period of financial repression where bond yields are below the prevailing inflation rate, and there's some counterparty risk out there. I think we're kind of entering an environment where gold is likely to be more attractive than sovereign debt in a lot of cases. That doesn't mean every single year. For example, we've had such a sell-off in bonds that I wouldn't be surprised, that now at these higher yield levels they're a little bit more interesting. But I think longer term there's going to be this financial repression where paper assets generally struggle in purchasing power terms compared to real assets, and gold would be one of the types of real assets along with silver.
And I guess really it so much depends on your client's time perspective, time frames. Obviously, perfect example. I was with a client who said, I've just sold my business for £700,000. What do I do with my money? I said, where is it? He said, it's in the bank. I said, oh, okay. You do realize that's an investment decision you've made there. That's not just warm, fuzzy feeling between your ears. That is an investment decision. And then you've got inflation running, this country, 10.1, 10.3%. So really, think about that as an investment. But then he said, yeah, but Andy, isn't it? It's just so volatile. I said, hold on a minute. So we drew up a chart, and there in the dollar index just hit 20-year highs. But what was the price of gold in dollars? $315 back then. So it throws that volatility aspect right out the window, because as a wealth preservation tool, so I suppose really time is the key answer here as to what percentage you want to put into gold.
Yeah, and I think it also depends on the opportunity set of what else is out there, right? So if you're in an environment where multiple assets are very cheap, relative to your assessment of how well they're going to do. So in other words, you have a high rate of return expectation on multiple types of assets. In that type of environment, then maybe people want a lower gold allocation. They want to go out into those, more generating type of assets, capital, to have a higher rate of return. Whereas if you're in an environment where, multiple things are very highly priced, like going back to sovereign bonds in 2019, negative yielding bonds, or near zero yielding bonds. That's basically another way of, and if you have a sovereign bond yield with a 1% yield, it's kind of like saying 100 price to earnings ratio, that is not going to grow, but is super safe, right? And so does that sound attractive to people? Most people would say no, but then you say, well, what about a 1% yielding treasury? And back then people were like, yeah, that seems fine. Or, obviously zero or negative, in many cases. And so in that environment where the opportunity set of stocks and bonds in general is unattractive in terms of forward returns, then gold becomes more attractive. And historically, if you look at things like, the CAPE ratio, the cyclically adjusted price to earnings ratio of the S&P 500, as an example, during periods where it's highly valued, generally the next 10 years, stocks underperform gold, whereas the inverse is true. If the CAPE ratio gets very, very cheap and you're able to actually get good dividend yields and good earnings yields, and basically the equities are under-owned, then generally going for the next 10 years, they're likely to outperform gold. And so I think we're in that environment where it's not at some of the extremes like it was before, but I think the opportunity set out there is really challenging, especially for the S&P 500, these big tech stocks that I think are still somewhat pricey, as well as still looking at much of the global sovereign bond market, and I think that the opportunity set of gold is better than a lot of those over, say, a 5-10 year period going forward.
Yeah, and I think another aspect, again, very gold centric, but when we see the liquidity flowing out of the paper markets of the COMEX into the physical exchanges globally, it's becoming much more of a physical asset. So I think on the other hand of things, we're thinking as another dynamic is what is the real price of gold? And if you take away that big, enormous 50 years of accrued paper, this paper sort of wall of supply that's been coming in, and suddenly we look at the COMEX, we look at it closely, we look at and obviously it's one thing to look at the COMEX because yes, you look at the COT report, you can see who's long, who's short. But what is missing from that report is, of course, what's happening in the over-the-counter markets, what's in the 10 times larger over-the-counter markets. So it's really not a great deal of help. But essentially what we are seeing is we look at the open interest evaporating. We see as wholesalers where this is going. And I think this is, again, back to Basel III, forcing, I think, certainly in gold. I mean, silver's joined at the hip, so I'm sure at some point that will have an effect too. But there's that other dynamic of gold actually becoming a more of a physically priced supply-demand aspect. And look, we were paying last week, and okay, it's come off a bit now because while India was very strong, we were paying $15 an ounce over in Dubai for wholesale kilobars. Now, hang on a minute, that is a huge disconnect from what is actually the tail wagging the dog, the COMEX tail wagging the physical dog, because then you're getting a fixed price, but the fixed price is actually determined by just 3 to 5 tons. When the global demand is global physical demand and deliveries is multiple times that. So it's kind of siloed in this little ring-fenced world still, which is, I think, I can see this changing rapidly as liquidity flows out. It's going somewhere. So I think the fact that gold should have a revaluation element to it. People ask me what the price of gold is. I don't know what the price of gold would be. I couldn't even guess, to be honest. But it certainly seems like a good element, especially you talk about the bond market being broken, essentially, is it not? Then these are other things to bear in mind, in my view.
Yeah, I think, during periods of history where we have kind of these just shifts in how the global financial system works, right? So, you had a shift, in say the 40s, you had another shift in the 70s. I think we're in that kind of era now. When you look at charts of major shifts, there's a lot of kind of similarities here. And so I think that investors do have to be aware of the possibility of nonlinear events, right? Where things change, over the course of a year, over the course of a weekend in some cases, and just things are different after that. And then you could have a pretty significant repricing in some assets. And I think gold is kind of near the top of the list of things that could go through repricing. And kind of by its nature, predicting something like that is impossible or very hard. It's kind of any given year, it's a low probability event. But I think that we're in that type of decade where some of those low probability events are going to happen. And I think we've already seen some of them. And I think that a shift in how the gold market works and how it's priced and kind of a check to see who actually has the gold is kind of one of those possibilities. And, one of the catalysts that I think could, contribute to that is right now, the market does kind of expect that inflation's transitory. If you look at, for example, inflation break-evens, for example, like the bond market's forward assessment of what inflation's likely to be, they're looking at much lower numbers than it is now. And I do think that we are in a disinflationary period from the prior kind of that big spike in inflation. So I think in a number of places that the inflation's coming off. But I think that we're still in a structurally inflationary environment when you look at, for example, the energy capex situation. And I do think that, once the Fed gets done with their period of tightening, I think that eventually the market's going to have a reassessment of forward inflation expectations. And that could change a lot of investor behavior around, how they treat bonds and how they look at gold, right? Because right now with the dollar soaring And with yields going up and investors kind of expecting that inflation is transitory, they're looking at these things as though they have positive real yields. And so that obviously, when you can get positive real yield on a bond, that can be pretty attractive relative to gold. But if the market reassesses its forward inflation expectations with rates at these levels, and you kind of have reassessment and you start looking at it and say, what if we're in a long period of negative real yields? Then gold becomes, it gets increased attractiveness.